Hey everybody, how's it going? Andrew here. You guys know me as the Wolf. I'm very excited to begin this journey with you um, in your stock education. So this is going to be chapter one. We're going to go over the process of becoming a day trader. We're going to go a little bit over some stock market information, just very basic things that I think are important for you to know. And we'll start to develop your trading skills. We are going to walk you literally A through Z on how to become a day trader. But first, you have to build that foundation. You have to build a solid foundation, just like any building, um, and build up. If it's not solid, ultimately it can crumble. And we do not want that, especially when we're talking about trading. That means blowing up your account. That means losing money. And we do not want that here, especially for those of you that are a part of quantum stocks. Okay, so I will be walking you through that. Now, who am I? Again, for those that do not know me, I've been trading for the past 11 years. I started back in 2009 and have been trading ever since. I started when I was a single dad, and through the years have developed my trading strategy by learning through mentors and books and various other ways. And from that time where I initially started, which was only with $500 back in 2009, adding a little bit here and there, the account has now grown over to seven figures in profit, which has all been proven and shown and authenticated over time, as well as showing my real-time trades. So I want to be able to help you be able to be profitable as well, which is where 90% of traders fail, is being profitable. Okay, so we're going to get into it. Again, I'm super, super excited to be doing this with you. And it doesn't matter what your background is, whether you are a student, a working professional, whether you're retired, regardless of whether your background, this is a skill set that anybody can do, which is why I love it so much, because it gives you that freedom that you can do it literally from anywhere. So, okay, with that said, let's go ahead and get into it. So part one, we're going to go over the initiation process. There's going to be quite a bit of material that we need to cover. We're going to go over what is day trading. We're going to go over broker overview. We're going to go over margin accounts versus cash accounts. We're going to go over the PDT rules, leverage, and why that's important, and why you need to be cautious with it as well. The various different types of order types, bid versus ask, level one, level twos, long versus short, volatility indexes, reporting your trades. And then at the end, we'll also have a trading plan for you so that you can develop your skill set. Now, before we do get into the PowerPoint, though, before we do get into all of this essential nitty gritty, what I did want to do with you is share first, the very first step that you guys need to do if you have not done so yet is one, come up with a brokerage. Now, for me, I like using TD Ameritrade. TD Ameritrade is a great application, is one, a great brokerage. Two, the application that they use is amazing, in my opinion. Now, when you make your TD Ameritrade account by simply opening up a new account, there's a couple of accounts that you can open, a cash account or a margin account. We'll cover that here within the PowerPoint so that you can understand which one you would like to open. But then the other thing that's important for you to do is open up this trading here and download their Thinkorswim application. And what that application looks like is this here. And we will get to this point here in the lecture today. I want to walk you through on how to set that up and be ready. And you know what? I don't know if I want to do it here at the end or here at the beginning. You know, we could go ahead and do it here at the beginning. This way you can get an idea of how everything's going to work. So the first thing that I'm going to do is I'm going to reset this. And where you want to go first, you'll have go to charts. And once you're within charts, what you want to do, well, I have to hit reset because I need to be back on how you guys see your screen when you first see it. So when you first see this screen, this is what you will see. And if I was to put a ticker in here, or in this case, a stock symbol, right? for example, OLED. What it will show me is the chart, and I'm looking at the daily chart, which essentially shows me the year's worth of data on this chart, how it's performed throughout the day, as well as the candlesticks. And I'm not going to cover everything in terms of the candlesticks and that. I'm just going to show you how to set it up now, and we will dive into that throughout the rest of your course experience covering candles and things like that. So stay tuned for that. It's something to look forward to. But right now is just the initial setup and how to set up your trading station. Okay, so once we are here, you will see that we have the chart, we have our volume, and then we have 3 charts below. I do not need all of these, so I'm just going to go ahead and get rid of them for now. Okay, now we have this big chart here, and we see that, again, we're on a 1 year, 1 day time frame. What this means is that we see the overall year, and each one of these candles represents 1 day. Okay, so if I went to a 5-day, 5-minute time frame, we're looking at the past 5 trading days. Okay, and each one of these candles now represent 5 minutes, which is depicted here on the right-hand side. Okay, so you get the idea. If we look at the 10-day, 30 minutes, we're looking at the past 10 trading days, and each one of these candles now represents 30-minute intervals. Okay, hopefully that makes sense. But let's go back to the 1 year time frame, or what we call as traders our daily chart. All right, now as we're here, the great thing about Thinkorswim, it's pretty customizable in the things that you can do, and it allows you to save quite a bit. So I hit this little icon here, this gear icon for the chart settings, and this is how I have it set up. You could set it up whichever way you like and play with it, but I kind of want to just walk you through on how to do some of these things. Now, what I like to do is overlap my volume, and when I hit apply, you'll see that the volume now overlaps and becomes part of the chart. Okay, if I take it off to show you how it was before, it's separated. I like it together. It gives me a little bit more real estate with my chart. Okay, some people don't, some people do. Again, it's your preference on what you want for yourself. Now, the other thing is the price axis. I typically do not fiddle with this section. You can if you like, but what I do fiddle with is the time axis. And what I do here is, if you notice on the far right of our chart, we are all the way at the edge of that chart. I do not like that. I like to give myself a little bit of real estate, a little bit of room to kind of see what is going on. So I will set this to 40 bars to the right. And when I hit apply, it now shifts 40 bars to the right. So now it gives me that little bit of real estate where I can have a better visual of where that stock is at, okay, where that last price is at, and kind of have a better estimate to kind of see where are we going, where we may be headed, okay? The other thing that I do not like is these dotted red lines. Now, these are more for option trading, and what it is this expiration Friday. So I'll just hit this here, hit apply, and now those are gone. Okay. The other thing that I like to do, and again, you could customize everything. You could customize the time frames that you like, whatever is your favorite, etc. The other thing I like to do is, for some reason, Thinkorswim doesn't fill up the green bars. I like it filled up, just my preference, and I'll hit apply. Okay, so now that we have this set up, this whole thing is called a style that we just did. We can save this style by going to Style, going to Save Style, and then entering in, you know, demo or whatever you want to save it as. And you could include the patterns and study sets within your style if you wanted to. So if I hit save, it is now going to save. The reason that that is important is because now if I add another chart to my right by clicking on this icon here, and I open up the same stock, OLED, it is back to the default. Okay, instead of having to go back to the settings and do all that over again, I'm just simply going to right click, go to style, load style, and we'll load up our demo style that we just made. And then there we go. Okay, so again, Thinkorswim is highly customizable. It's one of my favorites to use, but we could get rid of this for now. Okay. Now the other thing that you want to place into your chart are studies. Now I can share these studies with you via our Discord, etc. But what you would want to do is start, at least learn from scratch on how to set some of these up. So some of the studies that are important are exponential moving averages. So I'll just go to get here. I'm going to right click on the chart, go to studies, and you could go to edit studies. Okay, it makes it a little bit easier because then you could type. So here in this top bar, I'm gonna add in the word expo. Okay, and then as soon as I do that, I only have one option, which is our moving average exponential, which is what we want. And so I'm gonna double click, and it's going to add. Now the period that it is set at is 9. I will cover the moving average exponentials again in the next following chapters. Again, this first part is just to set up the chart and to set everything up. But this is essentially a very important period, and it will draw a very important trend line that is extremely important when it comes to your day trading. And this is what I use a lot to help me to determine of whether or not to enter or exit a trade. Okay, now there are other periods that you can add as well. So I could go in here and add in more, and you can change the time frame and interval by clicking on the gear and simply going right here and changing this to maybe a 20 moving average. And you could change the color and make this maybe yellow. Okay, now if I hit apply, now you see a 20 moving average, a 20 period moving average. Okay, and then if I go back to the gear and I change this to maybe 50, oops. And let's change this color to maybe orange and hit OK and apply. We now have a 9 EMA, a 20 EMA, and a 50. And this last one, we could come in here and we could make that a 200. Okay. And if I hit this, and maybe I'll make this one, we'll just make it purple, whatever, and hit OK and apply. We now have our 9 EMA, our 20, our 50, and our 200. And if I hit OK, we now have something here on the chart. The reason that these are important, and I'm just going to go over the 9 EMA. So what I can do, let me go back to my studies. And now you can add those in. And these are actually the EMAs I typically add to my chart. So again, a 9 period EMA, a 20 period EMA, a 50, and a 200. Again, I will cover this in later chapters, but if you want to take notes of that now, you can. Now, what I do want to, I'll go over the EMA here briefly and why it's important. Hit apply, hit OK. So now we just have the 9. What this 9 EMA is, it's the 9 exponential moving average. You could go and you Google the mathematics that are involved in it. But what the 9 represents, it takes the average of the past 9 periods. So here, each period represents a day. So it's essentially taking the average relative to the current candle that you're looking at of the past 9 periods prior and giving you a price. Okay, and it's going to do that for all previous candles. Again, it's all relative to the current candle or where it is at in relation, right? So what it does is take that average of the past 9 periods based off of the time frame. So here it's essentially the past 9 trading days because each candle represents 9 days. If I go and make this 5 minutes now, it's going to take the average still of the past 9 periods, but in this case, the past 9 periods are representative. Here, each period represents 5 minutes, so 9 times 5 is 45, and we're looking at this in a period of 5 minutes, so that's an average of the past 45 minutes, essentially. Okay, now why is this important? Because when you have a stock, a lot of the time, especially when you're day trading, become overextended, meaning that it's not so closely not so tight to the 9 EMA average. It starts to become greater, as we can see here. if I zoom in here at this period, we're starting to become extremely extended. We're not hugging this 9 EMA anymore like we were here and here. We are becoming extended. And when stocks become extended, especially off of the 9 EMA, there tends to be a pullback, or AKA a sell-off, which will then retrace and come back to that 9 EMA. Now, a lot of the time, once it hits that 9 EMA, you can have a bounce back off of that 9 EMA back to the upside and have a rally, which we see here. We were extended, pulled back to the 9 EMA, another following rally, a pull back to the 9 EMA, followed by a rally. Here in this case, once we pulled back, we had a breakdown and we had a sell-off. Okay, so that's why the 9 EMA is important. It kind of gives you a guideline of where that particular stock price should be. That's why we love it so much as day traders. Okay, so going back now to the chart settings, we are here. We should all be here at this particular point. Now, what I want to do is I do want to add below, actually before I add the below, what I also want to add in terms of study is I have a couple of custom ones, again, I could share with you, but one that you definitely want to add, and I think is important, is your MACD. Okay, and again, we will cover these in more in depth on how they work and why they are important in the latter chapters, but here is just simply setting up your chart. And again, I could share the custom coded ones because when I go to studies, load studies, I'll go here. And now we have all this custom stuff where we have it set up, right? So ultimately, you want to get to this point. And so again, I will share this with you in the settings with you so that we can get here. Now, this looks extremely crazy, but I will go down and break down each of these individually here. So going back to our study set, we'll go to edit studies. As you can see, I have a 9 EMA, a 20, a 50, and a 200 up. We could take those off for now so that you're not too confused. And then we'll take the VWAP off for now. And we could leave, I guess, the Bollinger Band. Okay, and if I hit apply, then we're there. And then let me take off this auto trend line. We don't want that. Hit apply and hit OK. Looks a little cleaner. Now, Bollinger Bands, and again, we'll cover this in more detail later, but the Bollinger Bands I like because if you remember basic like algebra, trig, your standard deviations, when you're looking at data, 95% of that falls within that parabola, right, that you have within looking at your standard deviation. And everything that falls 5% out of that becomes essentially an outlier. The same thing kind of works here with the Bollinger Band concept, is that 95% of the price action is going to fall within these Bollinger Bands, your lower and upper band here, which I have drawn in as dashed lines. Now, when they fall outside of these lines, typically they become an outlier, and depending on if you're already intraday trading, and once it does that, it can have a sell-off, okay, and start to break down. And then on the reverse side, when you start to have an outlier on the bottom of that Bollinger Band, it can be a potential buy signal for you to enter the trade for that movement back up. Now, it's not as simple as that. There's a lot more indicators and things that go into play, but you get the idea, okay? So going back to studies, load study, wolf trades, go back here. So now you see the Bollinger Band, and then I've already drawn in the EMA, so you understand those. So at 200 EMA, since we're looking, let's go back to the daily chart. The 200 EMA is essentially going to be the average of the past 200 periods, which in this case, each period represents one day, is going to be the average of the past 200 trading days. Okay, let's go back to studies, and we will, let me just take off that auto trend line. I don't really like it too much yet. Okay, so very clean. Then you have your MACD. Okay, now the other thing that I like to do is add a chart below. Because as day traders, what's very important that you have is the ability to see multiple time frames at once. So the first thing that you're going to want to do here is I want to link these charts together. So I'm going to change this link, which was unlinked prior, and change it to a 1, and change this to a 1. So now as soon as I change this to a 1, these are now going to be linked. Very much like walkie-talkies. We are now on the same channel, so we should be looking at the same stock. But as you can see, it's back to the default. I want to change this again, going to style, load style, and then hitting our demo. Okay, so now we have our style. And let's change this just a tad. I want more real estate for my chart than I do the other stuff. Okay. All right, so now we should be set up here pretty good. And now what you want to do next is you can change this, edit study, and for the yearly chart, all you need, and again, I'll explain this in more detail, all you need for when you're looking at the year chart is just your 9 EMA. You don't need anything else, just your 9 EMA, okay? And then here, when you're taking your intraday chart, your intraday trading, you want to look at a 5-day, 5-minute chart. That's typically what most day traders use, is that 5-day, 5-minute period time frame. All right. So you should have something that looks like this. And actually, before we get into that, I want to add this here to the right, and then this one down here below. Sorry about that. And then link these. So going back, right click, and we will load that study set. Oh, excuse me, load that style first. Add in our exponential moving average. And we only need the 9. Hit apply, hit OK. Okay, so you should have something that looks like this. And again, you can save all of this as well. So I have this saved, so if we end up struggling a little too much, I could always just share how to set this up. But as you notice, there's a bunch of things to the right of here. All we need essentially for these is just the chart. So I'm gonna uncheck this, which will now take this sidebar away, okay? And take the sidebar away. So now we should be here. And now I wanna link this one. And now we have all three communicating with each other, but I don't need that many charts. Again, all I need is a daily chart to see the overall trend of how the stock is performing. And I need my 5-day, 5-minute chart when I'm about to take my day trade on how the past 5 days have gone and see where I am today, right? Now, here what I want to have is my actual trading platform where I'm going to execute my trades. Now, to do this, you just simply take off the chart. I want to add a time in sales. The time in sales is essentially exactly what it means. It's going to show you the time and the sales that are occurring real time when the market is open. The other thing that you're going to need is your active trader. This is your bread and butter. This is where you're going to place your orders. This is where you are either going to hopefully make a lot of money or lose, in the worst case, lose a lot of money, right? Which is why you're in this course, because we will help you mitigate those losses so that you can maximize on your profits. Now, the other thing that's important when you're looking at a stock is the news. Okay, what is going on today? What's the new news on this particular stock? Is there an FDA approval? Is there earnings? Is there some type of good news, or is there a lawsuit, which could be bad news, right? So you definitely want to be current on the news. And then the other thing that you want is depth of the market, which also the active trader does show you the depth, but you want a level 2 as well to see a quick overview of that depth to understand what is going on. And we'll cover this again later on, but again, this is just to set up your chart. Now, once you're here, this is your bread and butter. This is where you will buy the market, sell the market, but this is customizable as well. And so one of the things that I want you to do is you can add these buttons in here. So by simply clicking buy, I want to have the buy ask, buy bid, and then I want the sell ask, sell bid. Okay, we already have the sell market up there. And then we can have, instead of this cancel button, let's remove that. Okay. And then we'll do a cancel all instead. Okay. And now with these, I can move these up or down, but let me just hit OK and see where we are. Okay, so now we kind of have something that looks like so. And you could, again, change this to match or however you want it to kind of fit within here. And if there are too many buttons, you could change it to be whatever you like, right? Now, once you're here, noting that this quantity and these buttons here are already integrated within Thinkorswim, meaning that they can't be customized too much. The thing that can be customized is the amounts. So if I hit 3,000, it's going to say I want to buy 3,000 shares of this stock at this price. So, I mean, if you do the math, the current market price is $170. If I buy 3,000 shares, do 3,000 times 170, that's pretty expensive. So if you want to customize it where you can quickly just hit a button, you can change, go to setup, go to application settings, and go to order default and change this default quantity to maybe be 100. Okay, so if I change this to be 100 and change this now to be 100 and hit apply settings, the bar now changes as you saw, and now I could buy in increments of 100. Okay, with the max being 1,000 or 2,000. All right, you get the idea. Okay. Now, once you are here, there's a couple more things that I want you to do to customize. Hit this little gear here and go to customize, and we are going to add P&L open and hit OK. The reason I like this is because it's real time. It'll show you when you're in a stock the current profit that you'll be making at these certain prices, or the current loss you'll be making once it hits these prices based off of the amount that you bought the stock at. Okay. And then from here, we can save all of this. This entire thing is called a flexible grid because we went to charts, flexible grid, and made all of this. And this annoying bar that's in the middle, we could take this off by going to this 3x3 grid, taking the customized grid and taking it off. Okay, so now you should have something that looks like this, very nice and professional. You're ready to take on the world as a trader and make these profits. So what you can do now is go to save flexibility grid and save this, and you can call it, you know, your trading station or your trading platform or whatever the case. And no matter what now, if you go to reset like I am right now and start all over from scratch, you just simply go back, load that flexible grid, and now you're here. Boom. Very nice and easy, and you're ready to go. Okay, and again, I could share my flexibility grid with you if you struggle at setting it up, but please take the time to try and do that and play with it a little bit. See what kind of works best for you. Some people like, instead of having your MACD and another indicator right here, you have 3 charts up. So they have their 5-day, 5-minute chart, they have a 1-minute chart, and then they have their daily chart. It's all your preference on what you end up liking. Okay? So with that said, let's get back to our PowerPoint presentation, and we'll go from there. Okay? But definitely wanted to show you that first so you can at least have that built in, because now as we start talking about it, it is there and already built. So now you could just add on, and now you could start to understand. But let's take it back. Let's go back to the importance of trading. Let's understand why trading is important and take our baby steps here. Okay, so why is trading important? I want to ask you that. Take the time And you tell me, in your words, why trading is important to you. Why do you want to spend the time to learn this? Write it down. I want you to write 5 reasons for you why this is going to be important for you in your life, in your future. Okay? For me, it was hugely impactful. As I mentioned before, it was a way that I was able to, one, help change my life, two, add that extra income to help provide for my family, and then now 3, I can still work a full-time job. I work in the biotech industry, which is an amazing career, something that I've always wanted to do my entire life, and being able to help people with cancer therapeutics and so on. But then also now I'm still able to day trade as a full-time trader as well. So I get the best of both worlds. That makes it really nice. So find out what that goal is for you and what it is that trading can do to help you. Okay, for a lot of us, it's adding that extra supplemental income, right? Now, what is day trading? A lot of people do not understand the full definition. Day trading is simply buying and selling shares of stock within the same day. The market opens, I'm on the West Coast, the market opens at 6:30 in the morning and it closes at 1 p.m. Within that span of time, I am taking a trade and I'm selling that entire position within that time interval. Now, the duration in which I hold those stocks can be dependent on myself. I could hold them for 5 minutes if I've already made my profit, 10 minutes, an hour, 2 hours, etc., etc. But the key defining factor is that before the end bell rings at 1 p.m., I am selling my position. I am out of the trade before the market closes. That is what defines a day trader. Okay. This became popular in the 1990s. There was the Wall Street movie. A lot of athletes tried to get involved with day trading. There was a lot of commercials involved with it. Then you had, again, movies and television to help make it look cool. And it started to blow up. People started to come out with early courses, coursework, etc. And it became popular. Now, even with that, 90% of traders will fail to become profitable today, just as much as it was years ago. And the reason behind that is greed and fear in not being profitable. Greed and fear are psychological factors that we cover in Chapter 2, where we cover risk management and psychology, which are the most important concepts to go over in day trading. So Chapter 2 is actually going to be very important for you to pay attention to, as well as Chapter 1 and all the others. But those factors are what lead to people not being profitable. And so we call those sheep. We should call those pigs. They get slaughtered. Our job is to teach you to be beast, to teach you to take profits when you have profits, and to compound over time. Okay? When you can understand that trading is a marathon and not a sprint, you will do just fine. Okay? And so what we are going to help you with is developing that risk management, having an idea of your technical skills, developing your technical skills, and giving you that small edge to maximize on profits and do what 90% of other traders can't. Okay, sound good? Absolutely. All right. Now, traders, when you're taking your trades, traders buy and sell assets. Now, there are various types of assets that you can buy on the market. There's stocks, which is what we will be focusing on for the duration of this course and what we teach. But you can also buy currencies, like a lot of people are into the foreign exchange market. You could buy commodities or alternatives such as real estate, options, bonds, mutual funds, ETFs, etc. Okay, but we are going to go over stocks. Now, what is a stock? A stock is simply a type of security that signifies ownership to a degree of a corporation and represents a claim on part of that corporation's assets and earnings. Okay? Now, there's always this question, what is the difference between a trader and an investor? What is the difference between a day trader and a swing trader, etc.? So as traders, as day traders, we have these criteria that we kind of look at: our outlook, our profits, the tools that we use, what are we concerned by, what are we not concerned by, what drives our decisions, and how much time do each of these take. Well, as a short-term trader, we take a strategic approach when we're determining our profits. We set up incremental profits, such as our 2-to-1 ratio. If you're in our trading room, you've heard me say that before. Set up your 2-to-1 ratio, set up your 10% profit target, your 5% profit target. Being able to understand what your profit target is based off of the technical analysis will help you take those profits at the right time. Okay, versus as an investor, they buy and hold a stock for a duration of time, a week, a day, a week, a month, a year, and hold it for appreciation. Okay, they are banking their pick that they're going to buy low, and over time that stock is going to go maybe from $10 in the span of a year now be $15. Okay, as traders, we are looking for that within a day. And don't get me wrong, we're not looking for big moves like that every single day, but we are banking that we hit a unicorn, and we have hit unicorns, and I'll show you some examples of those later on within this chapter. Tools that we use technical analysis. We break down the charts as a science, versus investors, they look at fundamental analysis. Swing traders as well look at fundamental analysis to a degree. Now, as traders, there's this big misconception that you only need to focus on the technicals. And it is true to an extent, but I would highly suggest that if you want to improve your level of skill, you also understand fundamentals. And the reason that this is important, and this is why the tool section, the more that you add to your arsenal, the better that you will become as a trader. So if you actually understand the fundamentals of a stock, what is driving that stock, what is the goals that that particular company has within the next 5 years, what is the outlook on the next 5 years, what products are they developing, what is their core values, how does the staff, how is the management run, what unmet need are they meeting, how are they serving the community, etc. All these things, as well as their balance sheet and so on and so forth, right? Are they in debt, etc., etc. When you can understand that, you can start to filter out the bullshit stocks, right? And use your technical skills towards the stocks that are more sound, and thus have a better probability of hitting those profit targets, right? Because as traders, we are going to trade some of those bullshit stocks. That's just the name of the game. We do trade stocks anywhere between $2 to $10, and we don't care if it's a company that does blah, 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 as long as we make our profit. Which sounds contradictory to what I just said, but if you want to be a little bit more technical, a little bit more picky, you will filter out those bullshit stocks by understanding the fundamentals, using your technicals, and using your technicals to then get in some of those better setups, okay? Now, what are we concerned with as traders? We are concerned with the day-to-day market movement, our risk management, understanding where to place our stops, okay? Long-term traders, they're just concerned with the long-term potential. Does this company have a good outlook? For example, Facebook. Facebook back in 2014 had a huge potential, right? Now, today, there's lawsuits. There's a lot of things that may drive that price of the stock down, right? So, again, they're more worried about the fundamentals. And so then on the flip side, we're not concerned with long-term potential and then investors are not concerned with short-term losses. And we could see that going back to your Thinkorswim just real quick. OLED, for example. OLED, let me take off this customized grid. Let me maximize this cell so you can see just the chart. We're looking at the year time frame. Let me clear out all these. Let's get rid of all this, remove all studies. Let's just look at the chart. Okay, back on 6/27, we know that this is 6/27, 2018 because it shows it on the top left over here, right under OLED. This was 6/7, 2018. The price of the stock was $78. Okay, in the span of a year, the stock has gone up to $190, hitting the high. As you can see within the day, a red candle is where it opened at the top, sold off at the bottom. A green candle opened at the bottom, sold off at the top. That's why it's green. Okay, you can see here that the price of this stock at one period went all the way up to $130 and sold all the way back off over the course of days and months back down to around that $78 mark. Okay, an investor or a swing trader or etc. could have bought the stock here, and they don't really care what happens here or even here. They are in it for the long run, and as they have held over time, the price of this stock has now gone all the way up to $190. Okay, which from their initial entry of 78, which if you draw the trend line, that is going to be about a 133% return on their investment. Okay? But at one period in time, it was even with what they bought at, so they had no gain at all. Okay, but they don't care about that as long as it's still above and still has potential to move towards that upside. Versus as a day trader, if we were trading this, we would not want to trade on this day, right? Where it had this big red drop, or these red, or as it was making this trend here, oops, towards that downside. Okay, we care about what goes on intraday, on the day-to-day stuff, which is why we look at the 5-day, 5-minute chart. We do not want to buy here at 186, and then now the price of the stock is now at 173, right? You do not want that because that's a loss. And as a day trader, again, we're only buying and selling within the day. All right? Make sense? And so the time devotion for us, we are heavily, you have to be very involved, at least on that day that you're trading, within looking at the charts, understanding the critical thinking that's involved, having your analytical research, etc. Versus an investor and a swing trader is a little bit more hands-off, you know, to an extent. An investor is way more hands-off than a swing trader, but you get the idea. Now, you're probably asking, well, what's a swing trader? A swing trader is essentially going to be a person that holds the stock overnight. They are going to hold it overnight for either a day, a week, a month, or a year. An investor may be more long-term, 2 years, 3 years, 4 years, etc. Right? Now, when you are swing trading, you are banking, going back to our chart, on gains that happen after market and pre-market. So, for example, here for OLED on 5/2/2019, the price of the stock was 152. Overnight, it gapped up and shot up to 178. And when it opened in the morning, and throughout that day, it hit a high of 190. So as a swing trader, you're banking on buying somewhere at a low, holding overnight or over the period of course of time, and banking here. Going back to the yearly chart, a swing trader is what I showed you earlier as well. You could buy somewhere within here, hold it for a period of time, again, a day, a week, a month, a year, until you hit your profit target, as well as looking at other components, right? When you're taking a swing, there's more involved than just the technical aspect. You have to also pay attention to the fundamentals, the news, etc. I'm just giving you we'll dive into that more and more as the chapters progress, but I'm giving you a very simplistic overview of how a swing trader operates versus how a day trader operates. Okay? Now, with that said, let's continue. Now, the benefits of day trading, you may be asking, there is quite a bit. One, you're going to still be able to have that capital gain, in which we've caught stocks that have made very big gains in one day. An example of this would be ABIO. We could go back the past 10 days. And on this day here, the stock was $7. And it shot all the way up to $12.53. The difference in price from that potential entry that you could have taken to that high point is 81%. In one day, you could have made 81%. But if you look, the price actually opened at $5.22. That difference in price is 150%, 145%. In one day, you could look to be potentially making 145% if you got this whole move, which never truly happens. But you could have definitely walked away with 10%, 15%, 20% if you had the right trading strategy, right? Versus a swing trader, they're trying to make that percent in the span of a year, right? So you kind of get the idea here, all right? So you can get the capital gain. You can make a substantial amount of money because as you're trading every single day, if you start to compound and you're successful, that will start to grow upon itself a lot faster than if you're swing trading or holding it more long term. It allows you to live and work where you like. You can trade, if you're in the US, anywhere in the US, I mean, even in other countries as well. But if you're primarily focused on U.S. trading, you could be in Miami, you could be in New York, you could be in California, etc. As long as you have a laptop and good internet connection, you can trade. Okay. You could be a student, professional, retiree. Doesn't matter your background. You can trade. There's no overnight risk as a day trader. And what I mean by overnight risk is going back here is, if I bought this stock here, or just say here, and I was holding it over time, you can see at some period, it started to sell off drastically, okay, overnight. And we could probably get a better look at looking at some other stock like, all right, OT maybe, where you can see that there's big drops overnight. You bought at a price here, and it went all the way down here at some point. Okay, that is overnight risk. You get that when you swing trade because you're holding overnight. You're hoping for the opposite, like here, where overnight it started to shoot up, but there is still that possibility where overnight it can start to crash on you. So as day traders, you do not have that overnight risk. But then on the flip side, you also do not have the overnight potential gain that you can have if a stock shot up drastically after hours, okay, after your trading hours, which it can happen based off of news and things like that. But we're not concerned with that, okay, because we are day traders. We have a day trading strategy. All right. There is a little bit of excitement, and this is more of a novice type thing. You are going to get excitement when you first start, when you're making your first trades, hitting your profit targets and making profits. But you definitely, as you become well-developed day traders, have to take the emotion out of trading and be able to essentially have it as a system versus having it be emotional, okay? And then there are disadvantages, right? Key level supports and resistances aren't well defined. So when we go through our technical analysis and draw these supports and resistance lines, they're not always finite, which we have gone over if you're in the trading room. We're trading against computers, right? You're trading against big hedge funds, high frequency trading, things like that. As day traders, again, you can miss the overnight gap ups, all right, and lose out on a more bigger percent gain. However, that's not the end of the world. It's a little bit more expensive for us as day traders because every day we are trading, or at least a good amount of days we are trading, right? In which when you buy and sell a stock, that costs money, that costs commission fees. Okay, so there is that you have to be aware of as well. And then for us, there's the PDT rule. If you do not understand the PDT rule, I highly recommend you Google it. I highly recommend you go to like Investopedia or etc. and learn the PDT rule. We will cover that here in this chapter, but it's very important that you understand it. Okay, and misconceptions of trading: that trading is easy, can make quick money, always highly profitable, that there's no risk involved, that all you need is a good tips or to be a part of a chat room, and just have very good scanners. And that is not the case. One, trading is not easy. You have to spend the time to learn it. It's like a new language. It's like learning Spanish or French or whatever, or learning a new sport. You have to spend daily time studying. Okay. The other misconception is that you can make quick money. You cannot make quick money on this. If you try to make quick money on this, you will lose, because by trying to make quick money, you're going to stray away from your rules. And by doing so, that will ultimately lead up to blowing up your account and losing your money. It's not always highly profitable. There's going to be days you lose. There's going to be months when you're in a drought. So understand that there is risk involved, but we help you to minimize those risks. And that number 5, you just need good tips. That is not the case. Having the right scanners is important because it helps you to find those stocks. But if you do not have the trading strategy involved to help you be successful, to take those trades that you see on the scan, you're going to lose. Okay? And then understand that trading is not gambling. Okay? A lot of people do not want to get involved in trading because they're like, oh, it's gambling with your money. That is wrong. Gambling is like going to Vegas, where the house has the advantage. Here, if you have the right trading strategy, you have the right set of rules that you follow strictly, you actually have the advantage because you put probability in your favor, and as a result, can walk away with profits daily, which is not gambling because you have a strategic approach on how you do it. Okay. Now, some of the challenges we'll face that most traders face is, one, they lose money and give up. I've had people blow up their accounts and like, I don't want to do this anymore. And it becomes discouraging. So we want to prevent that here, right? We want you to prevent the losing money. And when they have, it's because they didn't, well, one, come to a course first and learn from a good mentor. You know, they saw some video on YouTube and thought they can do it and lose their money. They didn't develop a trading strategy. They didn't understand how to minimize their risk, which is what we're going to teach you. So very important. Performance activity is very important, that you understand how to track your trades. And so then this way you can improve over time. Again, there's a lot of instruction involved. You can't do this alone. This is why we do this as a team. It takes hours of practice, which you already know already. I mean, this chapter already is going on for quite some time. And then understanding when to stop and when not to trade. These are all things that you're going to have to learn to overcome. Okay? Now, the process that is going to be involved is we're going to develop a trading plan. And in order to do so, you need to understand the language. You need to understand the key trading concepts, develop a trading strategy, understand your brokerage platform and tools. We went over a little bit of that already. Understand advanced key concepts. And then the most important thing is to begin practicing. To do so, instead of blowing up your account with real money, you can practice in a simulator, get a feel for how things work, and based off of your metrics, if your metrics are good, then you could take it to the live and now improve over time and be better at taking your profits. Okay. Now, what do you need in terms of the tools to be successful? You need obviously a working laptop and some monitors. For me, you do not necessarily need, let me get my laser pointer. You do not need dual monitors or 3 monitors. For me, I have multiple because one, within the chat room with you guys, so I share my live screen, which ends up going on my laptop, and then I use one side of the monitor to take my trades, and then the other side to look at multiple stocks at once. This way, I can be all tuned in instead of having to flip through screens. But you can get away with just a laptop. Completely fine. Okay? So with the laptop, at least a minimum of 8 gigabytes of RAM. Okay? It has to be a working laptop that has at least 8 gigabytes of RAM. High-speed internet would be nice. And then you need a profitable trading strategy, which we will develop. Okay? And now for your brokerage, what do you need? You need one, fast executions. You need a reliable and stable desktop trading software, in which this case, when we looked at Thinkorswim, that's a desktop application. It's not web-based. You're not going to, thinkorswim.com and trading within that web page. You have an actual desktop application that you open up. Those work way better than the web-based platforms. Okay? You need to have some type of hotkey, meaning if I hit shift buy, it will buy based off of what I set that hotkey at. Okay. On Thinkorswim, the cool thing that we have is we have this active trader where at the click of the button, I can buy or sell, which is great. And we'll go over those as we start to develop. Okay. So you have to have something quick. Right, you don't want to go in here and have to type, XYZ and how many shares and et cetera. You want to just be able to hit the buy button and be in and out of your trades quick. Okay. And you want to have discounted commissions at some point. You don't want to be spending a lot in commissions. All right. So this is a good point to take a break. If you need to go to the restroom, this is a great place to pause it, and we will continue on with the remaining of the chapters. We're only 17 slides in. There's 98 slides to go. All right, this is a very in-depth first chapter, and it's one of the most dry in terms of presentation and things like that. But these are all very important things that you need. Again, it's building your foundation. So this is a good time to take a real quick restroom break, pause the video, etc., and then come back. All right, but we'll go ahead and continue. So there are different types of accounts, as I was mentioning earlier, that you can open when you open up from your brokerage. You can open up a cash account. Now, a cash account will allow you to trade with only the available balance that you put in terms of cash. So if I invest $5,000 in my brokerage and fund it with $5,000, that means I only have $5,000 to play with. Now, when you're using a cash account, when you take a trade, say I decide to use 4,500 on Monday, and say I made profit, that money needs time to become realized and come back into your account. And it takes about 2 to 3 business days based off of your brokerage for that to become realized. So now that you've taken your trade, you do not have access to that money anymore until it becomes realized back into that account. So that $4,500 you had is now gone for a period of time. So then if you wanted to get back in on a trade that same day, all you will have is $500 left. Or if you wanted to trade on Tuesday, all you would have is $500 left. But on Wednesday, hopefully, based off of your brokerage, that money will now become realized and back into your account. So a strategy that you can use is to stagger that money. So if you had $5,000, you can put, maybe $1,000 that you're only willing to spend on Monday, $1,000 to spend on Tuesday, et cetera, et cetera. And the great thing about a cash account is you are not governed by the PDT rule. A PDT rule only applies to a margin account, and we will cover what that PDT rule is here shortly. Again, that applies to a margin account. A margin account, what that is, it allows you to also borrow money from your broker when you fund it, and you get leverage. When you open up a retail margin account, in this case, through TD Ameritrade and E-Trade and Ally, etc. When you open up a margin account, those are called retail brokerages, because anybody could just go online and join in. You get 4x leverage. So if I fund the account with $25,000, the brokerage is actually giving me 4x that amount. So now I have $100,000 total in buying power. I will have 25,000 in that is from me, and then the other being the other 75,000 being leveraged money from the brokerage. Now, when you have less than 25,000 to fund, you are governed by what is called the PDT rule. If you have less than 25 and say you funded it with 5,000 and opened up a margin account, you are only limited to 3-day trades within a span of time. Okay, so you can buy and sell within the same day. That's completely fine, but you can only have 3 full day trades, and that becomes a problem, because if you buy and sell, and then you wanted to sell, and if you're out of day trades, that can become a problem. Okay, or if you were shorting and needed to buy back, that can be a problem. All right, so there are those caveats that are involved with both of a cash account and a margin account, whichever you prefer is best for you. But when you have more than 25,000 in that account, you can take a limited day trades as long as you keep a minimum of 25,000 in that account. Okay, that is essentially the PDT rule. All right, and then when you open up an account, it's going to ask for 2 forms of ID, things like that. You'll go through it on TD Ameritrade. It's very self-explanatory. Whatever brokerage you go through, it's very easy to open. And then again, you could determine whether you want to open up a margin account or a cash account, etc. And now, when I was talking about earlier, there's a difference between retail and proprietary trading. Now, what the differences are, where you open up the account, the fees and commissions involved, the comparing leverage, and the education. So when you open up a retail margin account, as I was mentioning earlier, you need $25,000 to avoid the PDT rule, and you'll get 4x leverage. So that'll equal $100,000 in buying power. 75,000 of that will be lended from the brokerage. Now be careful. When you have a margin account, you want to try to stay away from the leveraged money, because if you lose that, understand that is not your money. That is the brokerage's money, and you will have to owe that back. Okay, and typically they give you a deadline on when that is owed. All right. Now, proprietary trading, you're going to take a series exam, your series 57, your series 7, etc. And then you're going to go through a private firm, and they are going to take you in. Okay, and with this, you can they give you 20x buying power, so you actually only need to fund it with $5,000, and they will give you $95,000 in lended money. That's very risky, but because there's so much risk involved, there's often more education that they give, because it's their risk that they are taking by giving you that money. Okay. So understand that difference. Okay. And then again, no matter what, you have to prove that you can be profitable over the course of time while you are trading. And then there is a difference in fees and commissions. Retail trading, again, there's a wide range and structure that you can have. In terms of charges, you can pay by per share of trading. You can pay a flat rate, etc. And then in terms of, you know, your education, again, as I was mentioning earlier, typically there is pretty good education in terms of the retail applications. Thinkorswim has really good education, but proprietary trading, you're going to get more of that hands-on, that one-on-one time, etc. All right. Now, when you take your first trades, again, first you want to ensure that you could be profitable in the simulator. And then after doing so and having shown that you can do so, taking that and applying it to your actual trading platform. And when it comes to being able to purchase a stock or sell a stock, there are different types of orders that you can take. There is the market order. A market order is simply to buy and sell. Will give you shares at the market price. This is the way of telling your brokerage, like, hey, I don't care what the going rate is. I want it now and give it to me now. And they will place the order and it'll be almost instantaneous and go through. A limit order, on the flip side, is saying, you know what, I'm going to be a little picky. I know that the current going rate for this stock is $2, but I only want to pay $1.80. So when this stock goes down to $1.80, or if a seller is willing to sell this stock at $1.80, that is when I'll buy. I do not want to buy it any more than $1.80. That is what you're saying when you place a limit order. And then when you place a stop order, you're saying, I want to sell at this price and take me out once it hits this. Now, for a stop order, there's multiple kinds. There could be a stop limit and a stop market. A stop market order will be as soon as it hits the price, and if for some reason drops down below that price, it'll take you out of the trade. For example, if I go back to the Thinkorswim, if I had placed a limit order, say at, you know, $44.60, and the price of the stock for some reason gapped down and went below, and now is at a price of maybe $4.26, this price would have triggered and said, hey, this guy wants to sell. This is the limit he was willing to sell, but he placed a market order. So now once the stock resumes, it'll then fill my order here and I'll be out of the trade. Now that could be a little risky because you have now gapped down quite a bit in terms of value. But typically a market order is sufficient when you're intraday trading and taking your trades, because it'll take you out as soon as it crosses that price. The only time you need to be cautious is if you're, you know, trading overnight or anything like that, or if there's a gap down in price, and we will cover what a gap represents and why there are gaps, but they do happen, and then when they resume, they could be typically bad, okay, depending on which flow they're going. All right. Now there are market types that we have. Now a market type, there's two components to it. There's the directional component, and then there's the volatility component. A stock in terms of direction can only go three ways. It's either going to go up, down, or sideways. And in terms of volatility, there's only two types. It's either going to be very volatile or it's going to be smooth and quiet. And so when you put these together, you have a combination here of 6 different ways in which a stock can appear and the type that it can appear. It can be bull volatile, bull essentially meaning moving towards the upside, or it could be bull quiet, slowly moving towards that upside. It could be sideways volatile, rapidly moving up and down, but the overall trend is sideways, okay? Or it could be sideways quiet, where it's just essentially a flat line. It could be a bear volatile, drastically moving towards the downside, or it could be a bear quiet, slowly moving towards the downside. So let's see if we could find a couple examples here on Thinkorswim that kind of represent that. So if we look maybe at, again, let's go to OLED. We can see, going back on the year time frame, we can see that overall from right here, oops, from here to about here, this has been a relatively quiet market, as it's not that very volatile, but it is moving towards the upside. So I would call this a bull quiet. A bull volatile will be something like we saw in ABIO, where you have these big spikes in one day that end up peaking, like how we saw going back to our 30 or 10-day time frame, where in one day the price jumped from 5 all the way up to 12. Okay? Or on the flip side, going from 20 and dropping all the way down to 12. Okay? That I would call extremely volatile. All right? As you can see here, pretty volatile. Quiet now, sideways quiet, could be something like this, where you have this range in price at 1116 to about 1071, if I zoom in here, where the market is relatively quiet, where we're going sideways but not super drastic, going up and down, versus if you look at, you know, maybe the past 180 days, let's see, maybe like something like Riot would probably be a better graph. Right, this is more volatile, right? It's not really smooth. You have a lot of up and down movement within each interval. Volatile. Okay, so going back again to the different types, you have a bull volatile moving up rapidly, or a bull quiet moving up slowly. Sideways volatile, staying sideways, but there's a lot of up and downs within that interval. Or sideways quiet, where you're just essentially super flat. Or a bear volatile and bear quiet. You get the idea. So the reason that this is important is because these are the types that you will see when you're looking at the stocks that show up on your platform. And so with that, each one of these has its own type of strategy or sets of strategies that are involved in how to take the trade. The way you trade a bull volatile market type in the bull volatile stock is not the same way you trade a bull quiet market type or bull quiet stock. Okay? So there could be sets of strategies involved with each, and that's why it's important to understand how that stock that you're looking at falls within this category, because then it tells you and gives you an idea of the strategy involved and how you would trade it. Okay? Now, going back to the stop orders, again, you can set a stop order, a stop limit, or a trailing stop. A trailing stop, we already covered the stop order and stop limit, but a trailing stop is if I go over here, and you know what, let me go to the on-demand feature, because I do not want to accidentally set in an order. But if I go to the on-demand, I'm now within the simulator that Thinkorswim allows by seeing this virtual account here. This is now the simulator. I can place an order. Let's go here, reset account. I could come in here and place an order. And when I place the order, it's going to fill, okay? And a trailing stop, what it does, I could go over here, cancel and replace order. And now I can change this stop type to be, where'd it go? Delete. Let me cancel. Let me cancel these. Let me go, I probably have to go here. Sell with stop. And I know you can do trailing stop, but for some reason I do not believe I have that set up right now. I'll come back to that. stop limit, standard. I don't want to take too much time. It must be that since I'm on the active trader, it's not working too well. Or actually, here, let me go here. Let me sell, stop limit, market. So you should have an actual option, which I do not see, which will be trailing stop. Okay, that trailing stop, what it does is you can set that as a parameter to trail the stock as it moves towards the upside. So what that will do is if this stock goes, say you set your trailing stop to be 5% or 10 cents, as long as the stock continues to move up, that trailing stop will now recalculate and adjust to move up as well. And when it drops down 10 cents, it'll take you out of the trade. But this is a great thing to have in place because when it does drop, you still would have maximized on some profits because that stop that you placed, like if I placed here, you can adjust, it'll automatically adjust as the price moves with the stock, okay? So that's where you'll have it. Now I'll have to go back and check in why I do not have it on my simulator, but it is a part of when you are doing it real time, you should have access. And again, you could just simply click here, go to sell, and you should have it as an order type within here, okay? If you do not, you just simply hit up your Thinkorswim by going to support, and they can help you out. Okay, but sorry I wasn't able to show a live demo there. This has to be that it's not on my active trader, which is fine because it is there on my real time. All right, so you get the idea. All right, and if you want the definition, there it is right there. Trailing stop orders, you put the stop on X number of cents or percentage based off of the current high. And if the price drops down and hits that, it'll take you out. All right. Now, the bid and ask is the next important thing when you're looking at trading. The bid is where the buyers can place orders and wait for somebody to sell them shares. The ask is where sellers place orders and wait for somebody to buy the shares. As a seller, to get the best price, we want to force somebody to buy shares at the ask price. Okay, but however, we can always sell to one of the buyers on the bid. So as a seller, you can sell on the ask, or if you notice that there's somebody willing to buy a certain amount on the bid, you can say, you know what, I'm going to sell, instead of selling 137 shares, I'm going to sell at 137 at 24.05. I'm going to sell the same amount but at 24.04 because there is a buyer willing to buy at that price at 24.04. Okay, and that goes into the level 1. The level 1 is the first depth of the market. It's going to show you the market price as well as the current bid price and the asked price. Okay, noting that when it shows 155 here, you have to add 2 zeros at the end because that is actually 15,500 shares that somebody is willing to buy at a price of 230 on the bid, and this is 300 shares a person is willing to sell on the ask price at 231. Okay, which is what we see here, 300 available at 231. All right. So hopefully you understand that. And so when you're seeing your charts, you can understand. Now, level 2 is a little bit more complex. This is giving you more depth. This is giving you more information. Level 1 is just essentially going to be this first top line here that we see here. We see 2406 is somebody wanting to buy 5,400 shares, and somebody's wanting to sell 13,600 shares at a price of 2407, which is what you see on the level 1, as well as what the current market price is. which is 24.06. But as you can see below that, this is essentially thinking of like baseball. You can see on deck what the next available price that a buyer is willing to sell this stock at and what a seller is willing to sell this stock at. Okay, and the difference between them is what we call as the spread. And when you have a tight spread like this, this is what you want. When you have a big spread, anything more than 10 to 20 cents, that is what you don't want. For example, if this was 24.06 and this was 24.16, that's a very big spread. Okay, that means that there's a big difference between the buyer and seller sentiment. Okay. And we will cover this again. We have its own separate chapter to go over all of these small components when it comes to level 2 and time and sales, but it's just an introductory chapter here to go over everything at once to kind of give you an idea of what to expect as we go on. The next thing in terms of that you use in combination with your level 2 is the time and sales. This is what we added to our charts earlier when going back to the Thinkorswim, your time and sales. It shows you the time and the sale that is going on, what is being bought, how many shares are being bought, what was the time that it was getting bought at, etc. And I have this moved overall to the right, but if I stretch this over here to the left, you'll start to see, since this isn't real time, it's not giving you the actual time frame, it's just giving you the date. But when we go back to our PowerPoint, you'll see that it shows you, oh, I have it set up where it just shows me the date, but it can show you the exact time that something is being bought to the very last, millisecond. In which here, you'll note it gives you more of an in-depth, a more micro detail of what's going on based off of the level 2 of how many buyers are coming in, how many sellers are coming in. And this is important because when you're about to take your trade, you want to know what the sentiment is. Is there more buyers coming in, which will help drive the stock up? Or is it selling off, in which I do not maybe want to take this trade right now because it's going to drop, right? The next important thing when thinking of stocks is float. Float is the amount of shares available. It's essentially your supply. But to give you the full definition, when a company has its initial public offering, they release a fixed number of shares onto the open market. This becomes the company's float. The float is simply the amount of shares available to trade. Okay, when we are trading, it's essentially in a small pool, right? And so you're going to have your institutions that have the amount of shares. Typically, they own 70% of the ownership, and the other 30%, comes onto the retail market, which we are as traders are able to take. Now, a low float stock, when you have a low float stock, you have a low amount of supply, in which case for us, we want to look at stocks less than 50 million of shares available. When you have a low supply and a high demand, basic economics, the price of the stock is going to go up, right? So as day traders, we look for low float stocks. Now there's mid cap, there's large cap, etc. And again, just as it is for the market types, there's ways to trade these. Okay, but we primarily as day traders focus on low float stocks because that is going to give us the most opportunity to make a return on our investment at a much quicker time frame. Okay. This is showing you the example of a low float versus a big float. Here, obviously, we're looking at a stock at $11, right? In which if somebody came in and bought, 20,000 shares at 11, that's going to drastically drive the price of the stock up. Versus here, we're looking at more of a big level float, and I don't know where I put the float size here. I'll have to get back to it. But for the more large cap stocks like, your Facebooks and things like that, when you buy 20,000 shares, it's not going to drastically change the price of that stock versus if you bought a penny stock and bought 20,000 shares. Okay. Now, again, when you take your order entries, going back to our active trader, you can simply buy the market, sell the market, or if you place your order within here, you can buy at the limit in which you bought the stock at. All right. And that's very important for your order entry. That's why when we went back to our Think or Swim, when we were here, if I go to buy market, it's going to give me the price at 451. If I went and bought the market here at 449, I'm placing a limit order and saying I want to buy this amount of stock when it's at 449. Okay. And then here again as well, what I'm looking at is again depth. So the current price of this stock is 2406. But if you notice, there's somebody going to sell 46,000 shares at a price of 2407. There's a buyer willing to buy 13,400 shares at 2406, but there's a very big seller right here. If I'm looking at this stock, even if my chart looks good, in which I have a big window of opportunity, I do not want to get in on that trade because there's that big seller which can potentially drive that price of the stock down, in which I'll lose that potential money. Okay, so now that you understand that, we can move on. So the difference, and the only two ways when you take your trades, you can either go long or you could go short. When we go long, we are banking on the stock starting at a low point, going up to that higher point. So if we're buying at $2, we are expecting it to go to, $3, $4, etc., and bank on that capital gain. When you're shorting, that's a little bit more complex. You're essentially borrowing shares at a higher price, and you are going to buy them back from the brokerage at a lower price and bank on that difference. Okay. Now, we're not going to cover everything in terms of shorting. We have our own chapter for that. But essentially, you're borrowing shares from the brokerage when you're shorting. You're selling the shares and buying back those shares at a much lower price so that you could get your return. Okay, so short selling is simply defined as traders that are short a stock are selling shares and creating a negative share balance. This means that they will be holding negative 1,000 shares. As soon as they sell the shares, they turn the profit from a sale, but they must buy back the shares. The shares have been borrowed from the brokerage to sell in advance with the intention of buying the shares back in a short period of time. Now this, I want to caution you on, this is like the dark magic of trading is when you go to short, because when you short, you can end up in a lot, because when you short, again, you're going to be in a lot of, you could tend to end up in a lot of trouble. The reason being is, especially if you're using a margin account, when you go long on a stock, the max that you can lose is whatever you put in. So if I went back to this Think or Swim chart and said, I want to buy 1,000 shares at $3. Okay, 1,000 shares at $3 per share, that's $3,000 that I invested on this stock, right? The amount of shares times the price that they are selling per share gives you the amount that you have to spend. Very basic. If you don't understand that, you should not be trading. Again, so if I'm buying 1,000 shares worth at a price of $3 per share, I'm buying 1,000 shares. I'm buying it at a price of $3 per share. So each share is going to cost me $3. So if I have 1,000 of them, that's going to cost me $3,000. Okay, makes sense? So if I'm buying $3,000 worth of this stock at here, I'm banking for it to move up. Okay, if it does not, in this case, if I did buy here, obviously it would have panned out really well. But if not, say I bought over here at 542 and it dropped all the way down below here. Okay, and say it went all the way down to 0. The max that I'm losing is only what I put in. So in this case over here, if I bought in at 3,000 and the price drops or they go out of business or whatever, I'm only losing that 3,000. When you short a stock, you are banking on the price of this stock to go from here down to here and buying back some of those shares and making your profit. But if I was short to say over here, and the price started to shoot up, I am now in the negative. And I'm now underwater because now, especially if I'm using leveraged money, I can be losing a lot of money. And if I'm leveraged, meaning I'm borrowing money now from the brokerage to take this trade when I'm using my margin account, I have to owe all of that back within a short period of time. So if you do not have the proper risk management when shorting, you could find yourself in a lot of trouble. Okay? So just be cautious on that. So again, when you do short, you have a certain duration in which you have to cover and sell those shares back. Sometimes it's 7 days, sometimes it's 14 days, etc. It just depends. And you have to give that money back. There have been people that have shorted and the trade did not go well with them, and they lost their house. They had to file bankruptcy. There's a lot of, because they got greedy, right? And they didn't know how to properly manage their risk, and that happens. So be cautious when shorting. We do go over it very in depth on following chapters, but just understand the risk involved when shorting. Okay. And again, there's the short squeeze, right? So this happens when a stock is suddenly starting to move up, and traders who are holding short positions start buying to cover their positions, all right, in fear of losing out. This creates an imbalance between the buy and sell, and a stock can end up making 50 to 100% moves in a day because of this imbalance. Okay, short sale restrictions, you need to understand that, occurs when a stock drops 10% or more in a single day. Once a stock has a short sale restriction, traders cannot take short positions except when the stock is moving back towards the upside. Okay, so understand that when there is a stock that drops 10% or more in a single day, you cannot continue to short it unless there is some positive move towards the upside. Okay, positions can only be taken on upticks at that point. Okay, this means that traders short at the ask price and have to wait for a buyer to buy the shares that they are trying to short. Okay, make sense? Remember, we covered the ask and bid. And so with that, there's two sides of the puzzle where you could take advantage of a trade if you develop your skills well enough. For example, here, you could have gone long, buying low, selling high. And then if you were, a guru and knew where this price peak was at, you could have ended up shorting and then short towards the downside and make profit as it went down. Just like the movie The Big Short, they were shorting against the housing market, right? So there's two sides of the puzzle. Some just prefer to be long biased like myself. Some are just short biased. Some are both. You will find your place in the market as you go along. Okay? And so understanding with the market, historically, the market has been a bullish market, has had a bullish sentiment. This is why this is reason as to why it's risky to short, because typically people are wanting to go long, right? All right, so here's another good place to pause. If you need a pause real quick, we're about an hour and 30 minutes in. We are 45 slides in. We still have about 45 to go. So you can pause real quick, take your restroom break, etc., and then come back and we can get into it. All right. So now going into the market overall, this would be a very short topic. Understanding, what is the stock market? We see this every day in the news, the TV, etc. What is the market? And just understanding, the stock market is no different than your farmer's market. It's a place where you're going to buy and sell goods. Okay, here in regards to goods, we're talking about securities. We're talking about stocks. We're talking about bonds, commodities, real estate. All right, versus, goods at a supermarket, you're talking about an apple, banana, etc., right? And so what helps with a stock when you're looking at a stock is if you kind of think to that farmer's market example. Say there's an apple. Say there's only 3 of them. So in this case, a low float, a low supply. There's no typical news into those stocks as to why you should, or in terms of those apples, why you should buy that apple. but you decide you want to buy all three. Okay. Now there is a scientist that decides to take a small sample of your apple before you leave the market, and he finds that those three apples cure cancer. There's only three in the world. You say you bought them at $1 each. Now there's only three of those stocks, or three of those apples left in the world, okay, that you have ownership on. And now the value of those are gradually greater, right? They are no longer worth just $1 an apple. Now maybe they're $1 million an apple. I'm just giving some extreme examples here, because there was really good news as to why you should buy those apples. And then for you, you can go and sell those apples now if you wanted to for a profit, right? You bought it at $1, they're now worth $1 million each. You can make quite a bit of money, right? On the flip side, if you bought, bananas, and you got two of them, right? And there was maybe 5 still left at the market, and they were, $10 each. And there is news that if you eat these bananas, you're going to grow a third eyeball on your forehead. I don't know, whatever the fucking case. People are not going to want to buy and eat those bananas, right? So the price of those bananas now are going to drop down in value because no one wants them. The same concept works with stocks. If there's good news for a stock, or, technical breakouts and a demand for the stock, is going to drive the price of the stock towards the upside. If there's a low demand or bad news or bad publicity, it's going to drive the price of that stock and the value of that stock down. Very similar. Okay? So as traders, when we are trading, we're looking at news. We're looking at the overall market. We're looking at what has the best potential to make a gain. We are looking at how the overall trend of the market is doing. So with that, we're looking at the S&P 500, and we'll get into that. We're looking at catalysts that can help us to identify some of these stocks that are moving towards that upside. Okay, so with that said, let's go on here. So what is the stock market and its components? Again, we already just kind of talked about that. We see it every day. When you buy and buy a share of stock, you're essentially buying a small piece of ownership to a degree, right? Doesn't mean you can make the decisions for that company, but you get the idea. Now going on, we could kind of skip through some of this here. This is all background. You could pause the video if you want to see some of these things that are here. And then the question is, why do companies go public? Why do they issue shares? And the main important reason is because it's a way to add capital to their company. They have an IPO, an initial public offering. They go and now have shares that are available for us to buy. And if there's a demand, it drives the shares up, and it helps them fund, their R&D, etc., without having to borrow and have leverage money for their business, right? Now, the components of the stock market, there's the Dow Jones, there's the S&P 500, there's the ETFs, the SVXY or the VIX, right? There's the different types of exchanges that we can trade on, the New York Stock Exchange, the NASDAQ, and the American Stock Exchange. We'll cover a couple of those here and go into so the S&P 500, okay, this is the most important that we look at, also known as the SPY. It's the short for the Standard & Poor's 500 index. This contains 500 of the largest U.S. publicly traded companies by market value. Okay, the index is widely regarded as the best single gauge of the large cap U.S. equities. Okay, other common U.S. equity benchmarks include the Dow Jones, the Russell 200 index, et cetera, et cetera. But as day traders, we solely depend at just primarily looking at the S&P 500, because the S&P 500 is encompassed of those 500 stocks. gives us a nice gauge of how the trend and overall trend of the stock is doing. So when we look at the SPY, it gives us a nice trend of how the market is performing. Especially when we look at this from a daily perspective. Okay, and when you typically have a nice uptrend when looking at the S&P 500 in your SPY, and you have a stock that is also towards the uptrend, you're in a good position. When you have the S&P 500 on a downtrend and your stock is on an uptrend, it is not as strong. It can still move towards that upside, but understanding you're going against the market sentiment, which is currently, if it's on the downtrend, a bearish market, all right? Which is what we saw at the close of last year, headed into that bearish market when we had that big drop, okay? And a lot of stocks went towards the downside. Okay, so the saying in Wall Street, the trend is your friend. The trend that we like to go off of in a chart that we like to look at in conjunction with the other charts that we're trading, you know, whether we're trading Facebook or other things like that, is looking at the S&P 500 to see the overall trend of the market. This gives you a nice, again, idea of how the market is performing. All right. The Dow Jones Industrial contains 30 blue chip stocks. All right. We, as day traders, do not give a fuck about the Dow Jones. We can care less. So that's all you need to know about the Dow Jones. You can read up more on it if you want, but in terms of this course and in terms of day trading, that's all you need to know. You do not care about the Dow Jones. And the reason I'm saying this is because you'll see a lot of the times the Dow Jones being talked about the most when it's being talked about on CNBC, when it's being talked about on Channel 2 News, 11, etc., whatever the case. They talk about the Dow Jones. We do not care. We care about the S&P 500. That's it. Okay? And then to understand what an ETF is, for those that don't know, it's a marketable security that tracks an index, a commodity, bonds, or assets like an index fund. Unlike mutual funds and ETFs, a common stock on the stock exchange. Okay, if we can figure out the overall trend of the market, we can trade the ETFs instead of all the different ones encompassed. So, for example, if you trade gold, all right, or a different type of ETF, you're trading all the components that are within that ETF, not just the individual stocks, okay? Then there's the volatility index. This is important for understanding the volatility of the current market. We call this the VIX. So when the VIX goes up, fear goes up, okay? When the VIX is higher or lower than it was before. So if the VIX is low, you're typically in a quiet market. If the VIX is up, you're typically in a volatile market. All right. And then you can see here VIX values that are greater than 30 are generally associated with a large amount of volatility as a result of investors' fear or uncertainty. Okay, while values of below 20 generally correspond with less stressful, even complacent times of the market. So more of a quiet market type. All right. And understanding that, you understand how the overall volatility is on the day. Okay. The New York Stock Exchange, okay, there's about 3,100 stocks that trade on this exchange. With this, typically you'll see the symbols within typically three characters for their symbol, all right? And when you see that, then you can know that it's traded within the New York Stock Exchange. The NASDAQ is typically like your tech stocks, your biotech stocks, etc. We primarily focus on NASDAQ stocks. These encompass 3,900 stocks. Okay, and these are typically have 4 characters within their name. So Apple, Google, Amazon, okay, OLED, OLED, etc. You get the idea. And then the American Stock Exchange is the 3rd largest stock exchange. It contains, you know, other stocks, ETFs, and derivatives. All right, not as popular, but still something that you need to be aware of. And I'm not going to go fully into it just because I don't think it's that relevant, but I just want you to know the different types of exchanges that are involved. Okay, so now we could kind of get into the nitty gritty of what we do and to kind of take a little bit of definition of way and misconceptions of what a penny stock is, right? So the SEC considers a penny stock to be any stock trading under $3 per share. So, excuse me, anything more than $3 is no longer a penny stock, right? We will find stocks between that $1 to $3, but then a lot of the times we do trade stocks over $3. These are no longer considered by definition penny stocks, but they are small cap stocks, okay, based off of their market cap, all right? And for us, we typically focus on stocks that trade, me personally, anywhere between $1.50 to $200, okay? Now, that means I'm trading small cap, mid cap, and then there are some cases where I trade large cap stocks that are over 200. With that being said, to grow your account the most, you primarily want to focus on stocks that are between that $1.50 to $10 mark, because as they move in terms of cents, that's where you end up making more gain. So for an example, a stock that maybe cost $1, if it moves 10 cents, that is a 10% gain on your entry, right? Or if a $2 stock moved 20 cents, that's a 10% gain. If a $3 stock moved 30 cents and now 3.30, that is a 10% gain. Okay? If a $3 stock moved to $6, which is only a difference of $3, that is double your investment. Versus if you're looking at a stock that cost $150 and moved up $3, which is now 153, that is not double your investment, right? So for stocks to help you grow your account, you primarily want to focus between $1.50 to $10. I typically do not trade anything less than $1, and to be even more nitpicky, less than $1.25. Okay. Now, when you find these stocks, the reason that these are important is because they can make huge moves. Here's 3 of them, which I was talking about earlier. GBR, on this day that we caught it, these all didn't happen on the same day, but I wanted to show you. It went from $1.20 to $13.80 in one day. This falls within our criteria of stocks that we trade, but as you can see, it gave you a return, a max potential return of 1,050%. That's huge. IMTE in one day went from $1.85 to $44 in one day. That is 2,278% return. That's big. AWX went from $216 to $36 in one day for a 1,566% return. All of which were massive, right? Those can quickly grow your account drastically. We call these unicorns. There was one this year, which was BPTH, which went from $2 to $79 in the span of 5 days. Huge. Okay, ended up being worth 80,000 after everything was all said and done in terms of trading profit from the time we caught it and traded it throughout the days. All right, these are the types of stocks that can quickly blow up and grow your account. Okay, but as you can see too, they can quickly sell off as well. So that's why as day traders, you want to be able to get in and get out before the mess. Okay. And understand you're not going to maximize and take the full profit here. There's no way you're going to buy at the low 185 and sell at the high of 44 perfectly and make the full 2278 return for percent. But you could have easily made 10%, 20%, 30%, 100%, 700%, 800%. Who knows? Whatever fell within your trading strategy, right? So that is why we look at small cap stocks, and in particular stocks between that $1.50 to $10 range, because they can shoot up drastically like we see here. Okay. Now, Minimum tick rules, typically stocks that trade over $1 per share trade in penny increments. Stocks that trade under a share trade in increments of 1/100th of a penny. That means an 80-cent stock might look like this with 0.8199, which is trash, right? We don't want that. All right, so understanding the definition of a penny stock, because the NYC requires that all companies keep their stock prices above $1 per share at a minimum. So when it falls below that, they can be suspended, they can be delisted from the exchange. And a lot of the times what a company will do is do a reverse split so that they maintain that minimum. And sometimes you'll see it shoot up from like 50 cents or 25 cents to $4, but all that was a reverse split. Okay. And so the OTC markets will then, if it does get delisted, comes into play. These are essentially over the counter. I typically do not trade anything OTC ever. These are stocks, again, that are less than that dollar minimum. Okay, and there's 3 different tiers that you can go off of. Again, I don't mess with any of these, but I'll put these up here because it is important that you know what they are. All right. So again, traditional penny stocks are going to be between that 0.01 to that 0.999, because once it hits $1, then you're no longer in that essential rules and regulation of potentially getting delisted. All right, there's sub pennies, there's 000 stocks as well that look like so. These are garbage. I don't trade these, but it is, again, I have to inform you on them. So there you are. Now, when it comes to reducing risk, we'll cover those in a second. This is more for the OTC stuff. Again, I don't trade it, but I'll leave this PowerPoint up so you can see it. But I'm not going to touch on it too much. We do cover risk management in Chapter 2 when talking about the stocks that we do trade. Alrighty, so we have about a couple slides left. We're almost there. Thank you for being so patient thus far. We're almost at the home stretch. All right, so again, just a recap, kind of some of the things that you're going to need. You're going to need your laptop, your trading station, right? You can have some monitors if you want. USB connector, which would be nice, so then you could hook those monitors up, give you a little bit more real estate on your laptop instead of having to use all ports, etc. And it's relatively cheap. You're looking between $1,400 to $2,100 on a nice, decent setup, right? So pretty inexpensive. All right, this MSI brand that you can have cost anywhere between $899 and $2499. These are typically gaming monitors. They're really fast. You could find any between 8 gigabytes to 32 gigabytes in RAM. All right, and you want a big screen for your laptop. If you are just going to use your laptop, don't settle for an 11-inch or 13-inch. Try to go for the 15 or 17-inch to give you a little bit more real estate, especially when you're looking at your trading charts and things like that. Okay, and here's, again, just a little bit more platform that you can use. You can have your dual monitor rack, etc. All right. And then going back to the beginning, we all have a place within the market. You are going to find out what is your place. Are you better at going long? Are you better at spotting reversals? Are you better at, having consolidation breakouts and technical breakouts? What is your accuracy? What time frame do you trade better at? Do you trade better at pre-market? Do you trade better at market open? Do you trade better at the power hour, which is at 12 o'clock on my time? Do you trade biotech stocks better? Do you trade big pharma stocks better? Do you trade healthcare stocks better? Do you trade tech stocks better? Oil, or whatever the case, right? You need to find your place, and that goes into tracking your metrics. And why it's important to track those metrics, because you can't improve unless you have something to go off of a base, right? And that is all part of the metrics, okay? And understand that there's this saying from, and I forget who says it, but I don't fear the man that knows 1,000 different kicks. I fear the man that practice one kick 1,000 times. Now, that's important because in trading, there's so much that you can do. You could be a swing trader. You can be a short seller. You could be long buyers. You could trade small cap stocks. You could trade mid cap stocks. You could trade large cap stocks. You could trade options. You could trade different types of derivatives. You could do foreign exchange, etc. And it could become overwhelming. Focus on one first. Develop your skill, and then over time, go into something else once you've mastered it, or just stick to it. Okay, we all have a place, and you need to understand that. Okay, don't try to get so involved with doing everything at once. You'll lose extremely quick by doing so. Okay, and making it look easy. When you guys trade with me, when you guys trade with other people, I make it look easy. I'm in the live and I'm saying, you know, I made $1,000 within 5 minutes. I made this amount, and I'm showing you my profits, and I'm showing you all real time, especially I'm calling out my entries and things like that. And I make it easy because one, you have to understand, it's taken me 11 years to get here. It's taken a lot of time, a lot of studying, and I'm still not even at my best. I've had one day when I was in the red for quite a period of time, and I thought I was going to lose out. There's been months when I've actually been days in the red, believe it or not. And it happens. That is part of trading. So understanding that, you know, this isn't easy. This isn't something that you can just go through the rest of this course and think you're going to handle it all. You need to be able to take this course and apply the material to your trading, and then develop. Okay. Now we're going to go into part 2, which is the simulator. Okay. And tracking your trades. So there's an Excel sheet that I sent to everybody on how to track your trades. And it's very important that you do that. And you know what? Let me open that up real quick. And I hoped I saved it. I tend not to save it sometimes. Is to track your trades. And it also helps you calculate your risk management. So typically, say if you had, you know, 4,000 in your account, it is going to say that your max risk per trade should be $40, which is 1% of your total equity, in which in this case, you want to typically go in 10% of your total equity per trade. So you're going to go for every stock that you're going to trade $400 worth, and you're going to set either a 5 or 10% profit target, in which this case here, my profit target is set to be 10%. So if I go in $400 and I make 10%, that's $40. Minus your commissions, of course, you're still walking away with profit. Your max loss per day, so your risk is going to be $20. We're going to cover this more in our risk management section and go over it more in detail, but you get the idea. But this is what I wanted to show you, is tracking your trades. You wanted to, one, find the source on how you tracked it, how you caught it. Was it on the scanner? Was it a gapper? Was it on the pre-market? Was it on our momentum scanner that we show within our live trading room? Was it a gap and go? Was it, you know, surging up? Was it, you know, a reversal? Was there a bull flag? What was your risk? How many shares did you buy? What was the price per share? What did you sell it at? What was the gain? What was the loss? Did you win the trade? Did you lose the trade? All these different things. What was the commission fees? What was your return? All these things you add up, and then you take metrics. This all are examples, but I put it in here. Were you long? Were you short? And then at the bottom, you track your metrics. Okay. And then you could take it a step further. You could even add, you know, what sector did you trade? Was it a biotech stock? Was it a big pharma stock? Was it a healthcare stock? Was it a tech stock? Was it a service and good type stock? Was it, you know, etc.? What sector was involved? And then you quantify even the non-quantifiable data. So this is all, you know, numbers and numerical data, but you can also quantify the non-numerical values, right? And then from there, you can track over time where you're better at. What is better for you? Do you trade better at the market open? Do you trade better at trading stocks less than $10? Do you trade better at trading stocks you know, between $20 and $25. All these things are important because then you start to develop a set of rules and guidelines which become your trading strategy. And then now you follow your set of rules and stay within your lane. Okay, when you start to get out of your lane and start to break your rules is when you could start to lose money. Okay, so that's important. And so for the trading simulator, for Thinkorswim, let me take off this on demand. When you open up your TD Ameritrade, there is this on demand feature here. And if I hit on demand, it is now going to take my account and make it a virtual account. I can't do real time on the active trader and on the on demand feature. So if you wanted to do that during real time, you just simply close out of here. And before entering in, let me show you. Let me open up another Thinkorswim window. If you wanted to practice a real time, like Monday through Friday when the market is open, instead of doing live trading, you're going to hit paper money, and then that will, and then enter in your credentials, and then that will be the real time simulator. Okay, the active trader, the on-demand feature within your Thinkorswim, when you go to the live, this is within the live segment, okay, and you hit the on-demand button, you can essentially, just like TV, you know, go and backdate and rewatch something that has happened in the past. So it's not real time, but I can go back here to a certain date, pick it, and then practice. And then it's going to simulate what happened that day based off of the data that it was able to recover. Now, it's not going to be 100% accurate because it has to recalculate everything that happened. However, you can come in here and practice. You can go in here and practice buying on the market. You can go and practice buying on the bid, etc., right? So there's all these different things that you can do and practice to give you a real-time feel. And the reason that this is important and why this is so good is because, like I said, with anything, like if it was a sport, right? You can watch a video on baseball. You could watch and read a book on baseball. You could get a coach to help you hit a baseball. But until you take a swing of the bat, you're not going to get better at hitting the ball. And that's going to take bat time. That's going to take you hitting off the tee. That's going to take people pitching to you. That's going to take hours and hours and hours of practice. The same with trading. You can take this course. You can take and read all the all the books, watch all the videos, do all the things right. But until you hit the buy button, until you get in on a trade, until you start to practice and understand the trends, you're not going to get better. This is to help you get there, but you have to take the time and do the homework yourself to practice the material that you're learning, okay? And that's going to cut, that means trading time. And that's why I love the on-demand feature within Thinkorswim, because I can go in here. This is the weekend. This is Sunday, 5/5/2019. I can go in here and set any date prior to 5/5/2019 and practice and simulate what happened that day and take a trade and see what it's like. Getting my bat time in, getting my trading time in, okay? Developing my skill set. Versus the constrictions of the other one where you only have, if you're using the paper money, which is good too, I would recommend doing that because Monday through Friday, as you're in the live trading room or whatever, you can see what other traders are trading and practice in the simulator to see if you would, you know, make the same returns as they do or do better or do worse. And again, these are all metrics that you want to copy and track so that you can progress. Okay? So hopefully that is helpful for you. So again, you can go to the real time. Let me take off the on-demand. Oops, I hit that one too many times. Let me open up back that window so I can make it clear. If I go into Thinkorswim and go into live trading and enter in my username and password and hit, that'll take me to the live account, which is what you see here. You know, if I hit the on-demand, that is when I could practice and backdate and practice any time of the week. If I hit the paper money, I'm only able to use it Monday through Friday. The paper money is real time, so it's only going to be active when the market is active on that day. Okay, so hopefully you understand the difference between both. All right, so getting that bat time in is important. All right. And again, I sent this out to you, so hopefully you guys got this. Very useful tool. All right, so tracking your trades, practicing the simulator. And with that, what you want to be able to do is, as you're tracking your metrics, have that develop into your trading plan. So the trading plan that I have laid out for you is the first month you should be in the simulator. Your risk per trade should be $50. So don't get that confused. That means you're not going in $50 per trade. That means your risk, so I'm going back to that Excel, your risk, how I have here at $20, your risk is actually going to be 50, right? Your max risk should be 50. Okay, so you need to calculate what that's going to be. You will understand how to do that in chapter 2. And then as you're in here tracking that risk, you want to slowly increase that over time once you're being profitable, okay? And once you're able to do that and you're able to successfully build, I've had students that have been able to make $100,000 a year day trading because they developed the skill set and were able to understand how to manage their risk, okay? So for the next, I would prefer the next several months, but if you have to do a minimum, at least of a month minimum in the simulator, whether that is practicing on the on-demand feature within the live or within the real-time simulator within the paper money, okay? And when you do not have a plan, I've had people that have lost a lot of money, you know, 30,000 in a day, 5,000 in a matter of 15 minutes. I've had people blow up their account and get a margin call because they leveraged their account. All right, these are all things you want to avoid. And that is all, one, developing a right trading plan, sticking to it, finding where your metrics lie, and setting up your rule set. Okay, so the objectives will be for you to do not exceed your max loss per day. So 50 is what we had set as your max risk per day, per trade, but you need to come up with a max loss. Maybe it's 200 or 500, whatever the case. You should not exceed that. If you do, you need to turn off your laptop and be done for the day, okay? You need to have an accuracy of at least a minimum of 50%. Okay, this means your profit to loss ratio, which we will cover in chapter 2, should be at least at a minimum of a 1-to-1, okay? And then when you do trade live, you're only sticking to the things that you have been successful at within the simulator, within your own set of rules, within your lane. Okay, you're not trying anything new. And if you are going to try something new, you're going back to the simulator first to practice. Okay? And then before you go on to the next step, what I want your metrics to be, and I want you to show me, is that you're at least 50% accurate in terms of your wins versus losses. You have at least a profit loss ratio of 1-to-1. Ideally, you want to be at a 2-to-1, okay? And you have to show me that you've been trading for the past 4 weeks, showing me your metrics, showing me what those results look like. And until that you can show that and be profitable, I do not suggest trading live. But again, this is just a recommendation. I can't tell you what to do, but I would like to see those types of things, okay? And trades per day, at minimum a minimum of 4, but no more than 10. Okay, your profit target, try to aim to hit $100 a day. Okay, your risk per trade, keep it at $50 per trade. Do not exceed losing more than $50 per trade. Okay, so if you're taking 4 trades and you're risking $50 per trade, if you lost all 4, that means $200. That means $200 should be your max loss. But since our daily goal is to hit 100, your max loss should never exceed what your profit target is going to be for the day. So your max loss is actually going to be set to 100. Okay, or you can adjust this to 200, whichever fits your case. All right. That's what I'm saying right here. Your max daily loss, if you lose 100 in one day, you should be done for the day completely. All right. And then understand which strategy, try to focus in on a strategy. If you're trading the gap and go strategy, if you're trading right at the open, if you're trading more of an intraday, if you're trading better at the power hour, figure out use that month to gauge where you're better at. Okay. All right. We went over this already. These are the metrics that I would like to see. Again, taking 4 trades per day, etc. All right. So with that, and then we'll get into month 2 once you get there. All right. So if we will have extra homeworks and quizzes if you need them. Feel free to ask if you want them. But this covers chapter 1. I know it was a lot of material. It was almost 2.5 hours worth of material, but it is extremely important for your career to at least understand this very introductory thing. As we progress into the following chapters, we go more into just looking at the Thinkorswim platform. We go more into in-depth of real time of how to make this happen. But you do need to cover your basics. You need to have that foundation, right? Build that solid foundation, because if you don't, it's going to start to tilt and you're going to fall. So go back, rewatch this, spend some time on this, take notes. I've had over 100 students that I have teach personally, all of which who have gone through this course have done extremely better after going through it, that have stuck to it. Okay, those that do not stick to the course, that do not stick to what the lessons that are taught, that do not follow their own rules, tend to lose. Those that dive in and take and do more than this, so aside doing side readings and practicing as much as possible, what you put in is what you get out. So I hope you put in a lot of time. I hope you take this serious, because this is your money. This is your future. This is a skill that's going to help you. All right. So thank you for being part of chapter 1. I will see you in chapter 2, where we talk about risk management and the psychology that you need to have when trading, and get into some real life examples on how to minimize your risk and maximize on your profits. Thank you, and have a good rest of your evening.